Okay, so now after that review, let's bring up a new feature of whole life policies. And these are what's called policy loans. So again, the contract you're signing with the life insurance company when you take out a whole life policy gives you the ability to borrow money from the life insurance company at predetermined interest rates. So for various companies and contracts, the formula they use or the rule they use to determine what the interest rate is in the policy loan could be different. So I don't want to get too specific. But the point is, the contract tells you ahead of time, this is how the life insurance company will calculate what the relevant interest rate is on these loans. Now, I want to be crystal clear here. When you take out a policy loan, you are borrowing money from the life insurance company. Okay, so it's not your money that you're borrowing from yourself, and it's also not the case that you're taking money out of your policy. You're not. All right, so again, what actually happens when you take out a policy loan is the life insurance company is using some of its money that it might have otherwise used to go buy bonds, let's say, and instead of buying some other asset with the money they have coming in their coffers that month, you request a policy loan, and so they make a loan to you. That's how the life insurance company invests some of its funds that month, for example, is they lend money to you, and now you owe them money. So that's an asset from their point of view. That policy loan is an asset to the life insurance company because they took some of their money and invested it in a loan to you, the policyholder. Now, what's the connection with your life insurance policy? The connection is this loan, this policy loan that you've taken out from the life insurance company, it has collateral. Specifically, the collateral that's guaranteeing that you're going to pay back this loan, the collateral is the cash surrender value in your whole life policy. All right, so just to repeat, when you take out a policy loan, you're borrowing money from the life insurance company at a particular interest rate. So not only do you owe them that money back, but the amount you owe grows at interest. But the collateral on that loan is, in fact, the cash surrender value of your life insurance policy. Now, this is very significant to understand why financing purchases in the IBC way is so advantageous. So again, the big picture is with IBC, you're building up wealth in the cash surrender value of a properly structured dividend-paying whole life insurance policy. As the cash value in that policy rises, it also increases the amount that the life insurance company is willing to lend you in the form of a policy loan. And so when you want to make a major purchase, what Nelson Nash suggests is rather than going to complete outsiders and borrowing money from them, you take out a policy loan with your whole life policy, or policies if you have more than one, serving as the collateral. And then you go ahead and make the purchase, and then typically you're going to want to pay back the policy loan as you're able to. Right? So that's what IBC is in a nutshell. So to understand why does Nelson suggest implementing IBC, which has to do with banking in the term of managing cash flows, what does that have to do with life insurance? Well, again, a dividend-paying whole life insurance policy is the platform upon which the process of IBC is implemented. Whole life insurance is the vehicle. So why? What's the benefit? I think a great way to understand this and to see why Nelson had such a great insight and why his epiphany was so important is to think about trying to do IBC with a home equity loan, let's say. Okay? So it's true, there's a sense in which you could bank, in the IBC terminology, with your house, right? You have a big purchase. Let's say your house is completely paid off, so you have that asset free and clear. You've got a big purchase. You have a wedding you need to finance. So yeah, you could go to your local bank, say, hey, I want to take out a home equity loan with my house serving as the collateral. Now, how is that different from you going to the life insurance company and saying, wow, I have a wedding I have to pay for. I want to take out a policy loan with my cash surrender value in this whole life policy serving as the collateral? It seems like those are pretty comparable, right? And no, they're not. In practice, there are huge differences that make the IBC way using whole life insurance much preferable. So one big difference is you're contractually guaranteed to be able to take out policy loans, and you know how the interest rate's going to be calculated on them ahead of time. Whereas when you buy a house, it's not that part of what you're buying is the contractual ability to just go to any bank and automatically be given a home equity loan with certain interest rate payback schedule built in, right? That's nobody's financially obligated or contractually obligated to give you a home equity loan. Whereas again, with a whole life policy, in addition to the death benefit and the other features that are contractually guaranteed, the cash surrender value that rises according to a certain schedule and so forth, you also have the contractual right to get a policy loan, again, where the interest rate's spelled out in a predetermined fashion. All right, so that's one important difference, that you know if you're going to do IBC the way Nelson Nash recommends, you're not going to ever hit a brick wall where the life insurance company says, no, we don't want to give you a policy loan. They have to. It's in the contract. Beyond that, though, when you call up the life insurance company and say, hey, I need $30,000 for a wedding I got to finance, they aren't going to actually, you don't need to tell them what it's for. I'm just doing that for the story. But you just call them up and say, I need $30,000. I want to make a policy loan. Go ahead and deposit it in my account or mail me the check or however they're going to give it to you. And so long as you have that available, and maybe they're going to ask you some security questions or something, because that's a lot of money to make sure you are who you say you are. But once they know you are who you say you are, they're going to go ahead and give you that money right away. They're not going to ask you what it's for. They're not going to run your credit to make sure your credit score is okay. They're not going to go and check your income to see if you have the ability to pay the loan back. They're not even going to ask you how soon you're going to pay the loan back. And here's one you might not even believe. They don't care whether you pay the loan back or not. You could take that $30,000 policy loan and never service it again. Just let it ride. And it would grow exponentially at whatever the interest rate was. And the life insurance company, they might send you some letters letting you know the status of it, but there's no action they're going to take against you if that thing just keeps growing. In contrast, let's say you wanted to finance the wedding using a home equity loan. You're going to go to the bank, and again, they don't owe you anything contractually, and you're going to have to convince them to give you a loan. And the bare minimum they're going to do is ask you what it's for. They're going to ask what your sources of income are. They're going to run your credit score, and they're going to insist on a certain payback schedule. And if you should happen to hit financial difficulty along the way and you start missing payments, ultimately, the bank could come in, kick you out of your house, sell the house to raise the money to then pay themselves back that home equity loan and then give you the balance. All right, so you see the difference there between those two approaches. Now, why is it? Why is the life insurance company so nice? Why are they so flexible? How come they let you take out a $30,000 loan, again, assuming you had that in your cash value, without asking any questions? And what do I mean when I say they don't even care whether you pay the loan back? How can that be? That sounds crazy. What are you talking about, Murphy? Well, here's what I mean. Again, it has to do with the nature of the collateral. When you go to the bank and take out a home equity loan, it's your house that's serving as the collateral. And in principle, even if it seemed like there was plenty of excess equity in the house so that the loan was over-collateralized at the point that it was made originally, still, the real estate market could crash. Or maybe you, as the homeowner don't take good care of it. And so ultimately, if you fall behind in the payments, the bank has no recourse but to evict you, then go sell the property, and then try to make back, your loan that you were delinquent on that way. So that's a real pain, and it takes time and resources on the part of the bank to go through all that. So they don't want to do that if they don't have to, right? The bank doesn't want to give you a home equity loan with your house as the collateral, and then it turns out you don't make the payments and they have to kick you out and sell the house and then get the money back that way. They don't want to have to go that route. It's very inconvenient, and it's bad, public relations to kick people out of their house. And so that's why, to protect themselves on the front end, the bank is going to have some criteria in place before they give you that loan in the first place. Okay, in contrast, think about it from the life insurance company's point of view. Your cash surrender value is the collateral on that loan. Who's guaranteeing the cash surrender value? How does the life insurance company know if you're good for that or not? The life insurance company is the entity guaranteeing the cash surrender value in your whole life policy, right? So the home office, the life insurance company itself, they are the ones guaranteeing the asset that is the collateral on the loan they're making to you. And so that's why they don't need to run your credit. They don't care what your income is, because if you don't pay them back, they know there's enough value in your life insurance policy to cover them. Specifically, when you die, I'm just making up numbers. Let's say your death benefit's $1 million, and the $30,000 you borrowed to finance the wedding, let's say it's been rolling over at interest because you haven't paid a penny of it. Let's say that's grown to be $40,000. All right? Still, when you die, instead of now getting $1 million death benefit, instead the life insurance company is first going to pay off that policy loan. So we said it grew to $40,000, so they're first going to pay themselves back, and now with the remaining $960,000, that's the money that's going to flow to the beneficiary named in your life insurance policy. All right, and so notice there's no hassle there. It's just an arithmetic problem. At the point at which you die, the life insurance company just looks to see, are there any outstanding policy loans that need to be paid off? And then if so, they'll go ahead and take care of them, clean that up, and then the remainder is what flows out is the net death benefit after policy loans to the named beneficiaries. All right, so there's no hassle there. Again, it's just an arithmetic problem. They don't have to go sell a house. They don't have to wait months staging it and getting it ready for the market and so forth. None of that. It's very easy to make good on an outstanding policy loan when the life insurance policyholder who took out the loan happens to die. So one way of thinking about it is from the life insurance company's point of view, a policy loan is actually the safest possible investment of their money. They are absolutely sure they're getting paid back because they themselves are guaranteeing the collateral on that loan. Even lending money to the U.S. government is riskier from the life insurance company's point of view than making a policy loan, right? Because in principle, the U.S. Treasury could default. A lot of people don't think that's likely anytime soon, but in principle, the U.S. government could say, yeah, even though the life insurance companies, you have a bunch of bonds, treasury bonds that we issued, we're not paying you for those. And they just become worthless. That could happen. Whereas it's impossible for a policy holder of a life insurance policy to take out a policy loan and not pay it back. Because again, even if the person doesn't actively make payments on it, at some point the person's either A, going to die, in which case the death benefit covers the policy loan balance, or B, surrender the policy. And so at that case too, if the owner of the policy surrenders it, then he or she doesn't get the full cash surrender value. It's only after any outstanding policy loan balances have been paid off, and then the owner of the policy only gets the net cash surrender value that's remaining after that. And so that's why, of course, when you go to take out a policy loan, the available cash surrender value is going to be the ceiling on how much they give you, because they don't want to be in a position where you owe them more money than there is cash in your policy.